Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Ed Yardeni of Yardeni Research, staying bullish. 3 consecutive years of double-digit gains don't happen too often. Nevertheless, that's what we're expecting. We see the S&P 500 increasing 19% this year to 7,000. However, we think it could be a bumpier ascent than in recent years. Ed joins us for more. In the flesh. Good to see you, sir.
Thank you.
Happy New Year. Let's start with that double-digit expectation for 2025. With some volatility, what's different about this year compared to last?
Well, I think we're starting off with more uncertainty on both monetary and fiscal policies. We really don't know how all these different policies that the Trump administration will introduce basically from day one. I'm sure there's going to be something like 20, 25 executive orders, coming very shortly after the inauguration. The problem is we don't really know how these things are all intermixed. It's kind of like a doctor prescribing a whole bunch of different medications to you and didn't check the computer that some of them don't interact too well. So we'll see how deportation and deregulation and tax cuts and tariff increases and what that implies for the deficit all mixed together. And meanwhile, the assumption is that the Republicans are in a position to get everything through. Well, maybe that's not quite the case. They've screwed it up before. They could do it again, I suppose. So there's a lot of uncertainty on the administration's policies. And then monetary policy is on pause right now. And the question is how long? And I think for a while.
Let's start with the administration. What are the assumptions that you've made, if any, that go into your forecast?
Well, I'm basically acknowledging that I don't know how it's all going to end up, but my gut feel is that when you add it all up together, it'll be an unbalanced positive for the economy. I think the other thing that's important to recognize, especially after the past 3 years' experience, is that the economy has been, as you mentioned, as Lisa mentioned, remarkably resilient to high interest rates. And so we really need, the economy is kind of like the Rodney Dangerfield of all this. Doesn't get enough respect. It's got its own dynamics. It's not totally dependent on what happens in Washington, D.C. And so I think we are going to see a productivity boom, which I think has already started, and that'll keep the economy moving at a faster than expected pace, and that'll keep inflation down.
Do you think that rates then are fairly valued, even though some people are saying actually maybe they're looking a little cheap after the recent rise at the end of last year? Mm-hmm.
You're talking about interest rates? Well, on the interest rate front, I was not in the camp expecting several rate cuts last year. And then at the end of last year, especially around September when the Fed chair started talking extremely dovishly, I couldn't understand that. I mean, the economy's doing fine. Inflation is pretty close to 2%. So what's the need for lowering interest rates? I think I think we are at neutral. I think we are where interest rates should be. The economy is doing quite well with it. And there's a lot of consumers, individuals, households that really enjoy having interest rates at these levels. A lot better than getting nothing for your money market funds.
Which is a reason why so many people have been piling into cash. It raises a question. If we do see a third year of double-digit returns of the 19% gains that you foresee, is that going to be concentrated again in the same leadership, given the fact that a lot of the equal weight, the broadening out types of beliefs really stemmed from the idea of lower interest rates?
Yeah, well, look, I think that lower interest rates certainly help SMID caps, the small and mid-cap stocks. And we had a couple of instances last year where all this excitement about rates coming down got them to do reasonably well. And then it all kind of fizzled apart in December as rate expectations changed. And suddenly maybe the Fed's not going to be lowering interest rates as much. And so, okay, everybody piles back into the Magnificent Seven. But I like the S&P 493. They've they've lagged behind. And, I think when you look at an S&P 500 portfolio, the way I look at it is all the stocks in there are technology stocks. They either make it or they use it. If you don't use it, you're going to lose it. You're not going to be competitive. So I think we have yet to see companies announce and demonstrate that all these technologies that are out there, not just artificial intelligence, but robotics, automation, and just thinking about changing your procedures in a way that makes workers more productive. A lot of that's going on, and we are actually seeing it in the data. My projection that we're in a productivity growth boom is really not so much a forecast as it is an extrapolation. We've already seen a pretty significant pickup in productivity. I think it keeps going.
We'd love your thought on US Steel as well, so hold that thought. We'll come to you in just a moment. US Steel right now, negative in the pre-market, has been all morning off the back of reporting that President Biden would block this deal. Getting confirmation. Biden blocking Nippon Steel's proposed takeover of US Steel. In a statement, the president saying the following: we need major US companies representing the major share of US steel-making capacity. That is why I'm taking action to block this deal. He goes on to say US Steel will remain a proud American company, one that's American-owned, American-operated by American union steel workers, the best in the world.
This raises the question of how this will be interpreted next year. This seems to be in line with what President-elect Donald Trump was talking about, that he also would block this deal. But it comes at a time where everyone is expecting a whole host of mergers and acquisitions as a result of a loosening in some of those parameters. And it raises a question: what's national security, what becomes political, and what will get through at a time when ostensibly this is going to be an administration more amenable to mergers.
That stock is down in the pre-market by around about 8%. Ed, to bring you back into the conversation, to build on what Lisa was saying, what's the signal you take away from this?
From the steel announcement?
Blocking the deal. To Lisa's point, what can get done, what can't get done?
I guess we have to conclude that the Biden administration is still in business. They haven't closed the shop yet. But it is consistent with what Trump's been pushing for, as you said. And it's also consistent with a regime change. In the Biden years and Obama years, I think you can kind of combine those years together. We had a lot of globalization, the idea that America's interests were identical to global interests, and we all had to work together, kind of a kumbaya kind of approach. Now we have, everybody pursues their own national interests, and we can talk about it and negotiate and work things out, but we're going to push for our national interests. You push for your national interests. We'll use our economic power to get what we want and to try to cut back what we have to give in return. And that's kind of the environment we're in right now.
But there's a real tension developing, especially at a time where people are talking about potential external foreign investment in the United States in order to gain a presence here, at a time where people are talking about mergers and acquisitions and the boom that possibly could really lift banks and other financial firms. How do you put that together with a real existential question about what is national security? What is going to be politically viable? Will this administration, the Trump administration, be excited about the idea of tie-ups even in the tech space?
Well, I think that it'll be more laissez-faire than we had under the Biden administration. Certainly we'll have more M&A activity. I think it's been going on kind of quietly in the tech field. It's just not public because a lot of the deals are Microsoft buying, a private company. That's one of the frustrations that small cap managers have, is they spend all this time putting together a portfolio of 20 great little companies, and they expect that only a few of them will become the next Microsoft, and it never happens because Microsoft buys them. So I think there's a lot of M&A going on even now, but I don't think the government's going to be as interventionist as we've seen under Biden.
So you're unabashedly bullish. You do expect this to continue to be the roaring 20s. What is the potential risk that you see out there at a time when we're talking to some people about gold, some people about the possible dissolution of some of the M&A fervor?
Well, you did mention that I'm looking for a bumpy year, and I would say that a lot of those bumps are going to be occurring over the next few months. We certainly have the uncertainty about monetary and fiscal policies. The bond vigilantes, my friends, the bond vigilantes commodities are acting up again, and the bond yields are around 4.5%, and getting a lot of questions, not just only can we go back to 5%, but could we breach that and go to 6%? I wouldn't be surprised if we saw 5%, and that would spook the market on a short-term basis, but I think we'll find plenty of buyers at 5%, just the way we did last time. And then, of course, there's geopolitical concerns. The Middle East is still a mess. We have yet to see what Israel's going to do next with regards to Iran, and what Iran will do next with regards to Israel. So that confrontation is still ongoing, as is Ukraine and Russia. So I think, you put it all together, and at least for the first few weeks of the year, I think there's a potential for the market to weaken, and maybe perhaps even a correction, but I would view that as a buying opportunity.
Certainly weaker over the last week. Ed, it's good to see you, sir.
Thank you.
We should do this more often in person.
Absolutely.
Thanks for being here. Ed Yardeni there of Yardeni Research. Investors looking ahead to key dates this month, starting with next Friday's payrolls report, followed by CPI and a Fed rate decision at the end of the month. Claudia Sahm of New Century Advisors noting the Fed's summary of economic projections isn't living up to promises, writing, tension has been building around the SEP at the Powell Fed. The Fed has long been data-driven in its decisions, but the complexities of the post-pandemic economy have led it seemingly to rely on data over forecasts. Powell even admitted as much at the press conference. Claudia joins us now for more. Claudia, welcome to the program, and a very happy new year to you. It's good to see you once again. How is this complicating decision-making on the FOMC?
Well, I think, a real theme of the last FOMC meeting was how much uncertainty there is about the outlook for 2025. And a lot of that comes from policy uncertainty, out of fiscal policy. But, the Fed has increasingly under Powell become very data-driven, and it's hard to believe it, but I think we're actually going to see a year where the data plays an even bigger role. And we already know that can create a lot of unnecessary volatility, because it's hard to measure a $30 trillion economy in real time with a lot of accuracy. So I think we're going to continue to see this real overreaction. And we saw this yesterday with the initial claims for unemployment data, to just, these little scraps of data we get on how strong the labor market is, how hot inflation is, so buckle up.
Well, Claudia, this is a reason why people can't liken the moment that we're in to a dark room with a blindfold on, with lots of furniture going around and trying not to bump into anything, because the data is messy. We keep talking about distortions, but forecasts have been wrong. And the whole concept of transitory is a huge scar over this Fed. So is there a forecast or an economic model that they should be following? And I'm asking you of the Sahm rule, who has come out and talked about how every rule has its exceptions, and it's difficult to really come up with these.
Right. Yeah. This is the past 4.5 years have not been kind to rules or rules of thumb or how it's usually in the past. But we also can't become hamstrung by a mistake or a misjudgment that was made in 2021 about inflation. Right. We have moved forward, and we've seen the economy slowly over time heal. We're seeing patterns that make a lot more sense than they did in the early days of the post-pandemic recovery. So the Fed, yes, and that's exactly how it feels. In a dark room, moving. We know there's furniture, but part of the Fed's job is to help turn the lights on and at least chart a path. And yes, that could mean redirecting, but to just, what we do this next year, it's going to be all about the data points we get. That really sets up, I think, a lot of unnecessary volatility. Like the Fed is injecting volatility because it's saying, just follow those data points. And we know we get bounced around by them. So you need to have a grand plan in terms of how you're working your way through the year. It's tricky. Like the policy uncertainty is real for this year and for the Fed. So I'm not saying like I have an easy solution for them, but now is not the time to back away from some of the forward-looking, the heuristics that we have.
Mohamed El-Erian would agree with you. He's talked about this as much, the whole over data point dependence. What patterns are you observing that you think are going to be important and prescriptive for what's to come in the U.S. economy?
Right. So I keep all eyes on the labor market. I think that's such a linchpin to the resilient economy we've had and the ongoing recovery, in addition to, millions of Americans' lives really depend on their paychecks. And this is one where I worry that the Fed is somewhat complacent. I think they're being hypervigilant on inflation, as we know the Fed often is and should be. But their outlook that most of the officials laid out in the last summer of economic projections is a pretty optimistic one on the labor market, and basically saying, hey, we're back to normal. We're back in, I think Mary Daly even used the words kind of an equilibrium. We got one vacancy for one unemployed worker, and it's close to what the Fed thinks the long run unemployment rate is. And they project that to stay with us. Like, hey, we've got back to equilibrium. We've got back to a good place. We're going to stay there. And I think there's a lot of other dimensions you can look at the labor market, particularly the differences between the hiring and the firing. The hiring doesn't look so good. The firing looks really pretty great. Like, that's not typical for a labor market, that's in balance, that's in equilibrium. And so I think there are some signs, and that's what we have to keep an eye on, are the places where it doesn't make sense. And another big piece is we've had a big push from the increase in labor supply, from the immigration into this country, which has been extraordinarily high in recent years. And that's turning. Or even if we don't have mass deportations, we're not going to have a big push from the outside immigration. And that's been an important dynamic of the labor market. We're going to watch it unwind. So I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it. I mean, we're going to get our first taste of the data next week with the report.
Payroll's coming on January 10th. Just quickly, Claudia, how unusual would it be for unemployment to stabilize at these levels after coming off the lows to the extent that they have?
It would be very unusual to stabilize and hold in this place for like the next 3 years, which is essentially what the Fed is projecting. But that's saying that we're in a good place and we're going to stay there. But there is a sense that, barring a lot of this policy uncertainty this year, 2025 really could be, it still could be, but it was on path to be we get to the sustainable place. We work out some of the last disruptions. So we'll see.
I hope you're right. Claudia Sahm of New Century Advisors. Claudia, appreciate your time. Thank you. I think we all hope Claudia's right. Stephanie Roth of Wolfe Research, Mark Cabana of Bank of America joining us around the table. To the two of you, good morning and Happy New Year.
Good morning.
Good to see you both. Let's start with you, Stephanie. Expectations for a week today in a payrolls report.
Yeah, so we're looking for 175 on payrolls, which sounds a little higher relative to expectations. But I think the surprise from the report, just given where markets are, is that it could come into the soft side. Forgetting about the headline number, there could be downward revision to the prior 2 months. And importantly, we're looking for an unemployment rate that could tick up a little bit higher than what expectations are looking for. So there might just be some soft pieces of the report that at the margin could put some downward pressure on yields.
Where's the weakness come from? Because I think the bulls right now would say claims are low, layoffs are low, things look pretty good. What looks bad?
The breadth hasn't been very good in terms of hiring. That's been quite disappointing. A lot of the gains have been driven by healthcare and government, and that's not a sign of a really, really strong labor market. So we think the labor market is fine. We think the underlying trend is 140,000. But at the margin, that's probably a little bit softer than where consensus is at the moment.
Mark, we were talking earlier with Claudia Sahm, and she was talking about how the Fed has really injected a lot of volatility into the market, and the rates market in particular, as a result of its data point dependence. Do you expect there to be quite a bit of volatility either way if there is any kind of surprise whatsoever on Friday's payrolls?
We do. We also think that volatility is going to be a little bit higher in the rates market this year, simply because the Fed is so data dependent, and there's still so much we don't know about next year. How will all these economic policies take shape? What will the impacts be? And so we do think that a very data-dependent Fed in that context will just keep rate vol a little bit higher than it otherwise would have. Now, if we get the kind of number that Stephanie was talking about, if we see some softness in the underlying data, we do think that there's pretty good potential for rates to move quite a bit lower, largely because we think that there's so much good news that's priced into the market right now. There's so much optimism about U.S. growth remaining strong, about around elevated risk asset valuations, that if you start to see any wobbles in the economy, then we do think that there's a fair amount of a reassessment that's going to have to happen, and that should mean lower rates.
Do you think that that's the bigger potential surprise, is actually some weakness that spurs spurs a rally just based on the positioning so far?
A rate rally, yes. Look, we generally perceive that right now optimism in the market is extremely elevated, and we've seen that over the last few months. There's a great deal of expectation that this is going to be a super growth-friendly administration, and that's that their scorecard's going to be the S&P, and that's essentially, we think, driven risk assets to very, very elevated values. Whereas we think that the range of outcomes next year is much wider. We don't know exactly what the policies will be. We don't know what the impact on the economy will be. And as a result of that, we think that there's a little bit of a mismatch there. Elevated optimism versus a very wide range of outcomes. And we do think that that should be supported for duration, at least in the early part of next year.
Stephanie, on policy, what assumptions have you made about policy changes from the incoming administration through the next year or so?
So for this year, we think it'll be mostly about deregulation, which is a positive for growth. The tariff thing is, of course, one of the biggest questions. We don't think that will happen until later this year, partially because they want to tie that to TCJA. And importantly, like Mark said, there's a ton of uncertainty when we're thinking about policy, but we think a lot of it's going to be relevant for 2026 rather than 2025. But it's not likely to be that stimulative, right? The TCJA is a $4 trillion tax bill that's going to be just keeping policy as is. It's just to keep policy largely steady. There's going to be a couple of things that could at the margin be growth positive, but then we have tariffs, which are a massive headwind.
Well, just on tariffs, are you saying that the primary objective of tariffs will be for revenue-raising purposes from the incoming administration? Is that what you're suggesting when you're saying the two will be tied at the end of next year?
I don't know if it's necessarily the primary objective. I think the primary objective is, Trump genuinely believes in tariffs, but then they do raise a lot of revenues, and that's something that they're going to need a whole lot of when they're thinking about this tax package.
Mark, you mentioned this, and I think it's important. Policy changes is one thing. Anticipating the economic consequences of them is quite another. It's not obvious to me how inflationary or not tariffs would be. Depends on how they're put together, how they're executed, whether you get retaliation. Also completely depends on what happens elsewhere in foreign exchange, investment decisions made by companies elsewhere that want to be in the United States and want exposure to the US economic story. What kind of assumptions can you make on changes and consequences?
I think it's really challenging for Stephanie and other economists. Look, our economists, I think, have done a very good job trying to dimension to the best of their ability what the key considerations are. But they'll be the first to tell you that the range of outcomes is extremely wide and that their confidence around these assumptions that they're making is extremely low. And you're right, Jonathan, there's so many other things that can impact the potential inflationary consequences of tariffs. Look at CNY overnight, right? It was 7.3. So you're starting to see the FX markets price some of this in. And to have a lot of confidence around what the overall economic outcome will be is, we think, very, very it's very, very difficult at this point in time. Now, to be overly concerned around inflation, yes, some of these policies could indeed be inflationary. They were not terribly inflationary last time. And what we think the market should be spending a little bit more time is trying to think about, okay, well, what is the Fed's reaction function? Last time their bias was to look through any potential inflationary impact, or at least that's what the transcripts tell us. This time, of course, the macro backdrop is different. Core PCE is more elevated. We just went through a very inflationary period. So will their reaction function be the same? We don't know yet. But to me, that's what I'm going to be looking for to think about what the impact is to the bond market. And right now, my bias is still to believe, and our team's bias is still to believe, that the Fed's likely impact will be to look through to the extent that they can, especially if they start to see that tariffs have any type of negative growth impact. Finally, look, just to go back to some of the points that Stephanie made, I think they're really good. Just think about where the market narrative is right now and what Stephanie said. The policies are probably not going to be all that stimulative. Impact mostly in 2026, not 2025. Where is the market right now? Look, you two talk to a lot of people. You'll know probably better than me. I talk to a lot of clients as well. I generally think that clients' mind frame is that these policies are going to be impactful near term and that they will be quite stimulative. And again, that's where we think market optimism is. Range of outcomes is a lot wider. And again, for me as a rate strategist, I think that probably means lower rates as you see some convergence in this.
We were just speaking to Ed Yardeni, and he actually came out with this fantastic analogy, which is essentially that this is a doctor who prescribed all this different medication without running it through the computer to see which interacts with which. It raises this question of how important is that mix of policies based on where the economy is right now. Stephanie, from your vantage point, Mark's talking about how he thinks too much optimism is baked in from policy perspective. Is there too much optimism baked in with respect to the economic data that we've already gotten in terms of where we are coming from and how much inflation is still in the economy and how much momentum there is?
Yeah, I think that's totally fair. Like part of this, these things go hand in hand. So what's baked into the rates market is the expectation that the economy is running on all cylinders, quite strong. And it is, but it's probably not quite as strong as the outlook suggests. And the FOMC kind of introduced a little bit of extra optimism about the economy. That's probably gonna disappoint to some extent. We'll probably see payrolls running a little bit slower, allow them to actually cut certainly 2 times this year, and the market's pricing in a little bit less than that. So the economy's running just fine, but the expectation is similar to what Mark just said, that Trump's policies are going to be incredibly, growth positive, and they're going to be happening right now, and they're probably not. It's going to take a while for a lot of the stuff to play out.
Do you agree with Mark that the Fed's bias is going to be to look through any of the temporary effects of some of the tariffs?
I think that's what they should be doing, in the sense that if they don't and they start becoming notably more hawkish as a result, that could be a recipe for a recession, in the sense that we are largely at full employment. This could become a real problem. If we start to see the Fed reaction function look quite different than what it was last time, we might have a real problem, in which case growth is likely to slow down notably as a result of these tariffs. Tariffs are stagflationary.
Mark, I'm just curious, when you take a look at the Fed's reaction function, we were talking with Claudia Sahm, and she was saying that they have introduced this volatility. We were just speaking about that. She was saying that they should follow models a bit more, and in particular, some of what she's seeing in the employment market. What would you be following if you were on the Fed as your sort of lodestar for where the economy was heading?
Yeah, look, in periods of very elevated uncertainty, which I think we are in and are going to continue to be in the early part of next year, we think the most basic monetary policy rules can be very instructive, like the Taylor rule. Now, any model is only as good as the assumptions that you want to make and the inputs that you have into that. But we do think that Taylor has been a pretty good guide over recent years. The Fed does not, nor should they, follow it blindly, but they should use that as a meaningful input. Other Fed officials, Chris Waller, has talked about how they do indeed do that. And right now, at least, they've pretty much converged to near where Taylor suggests that they will be. And the big question is, what does the data imply from here? The market thinks that the Fed will only need to cut about 40 basis points more, and then they'll be done. But if you actually use the Fed's own economic projections in their SEP, the medians and the unemployment rate, as well as on inflation, core PCE, it suggests that they should really be cutting probably something more close to 100 basis points. And so it really depends upon, again, what are the core economic assumptions that you have. The market's very optimistic right now. I think that growth's going to remain strong. The unemployment rate won't rise much above 4.2, maybe 4.3. Inflation's going to stay sticky. But if you do see inflation move down, or if you do see the unemployment rate tick up a little bit more, then the market's going to be talking about a Fed that could potentially be cutting a lot more than what is currently priced. Look, just final point for me. When I think about the Fed's reaction function more broadly, and I think we in the rates team agree with this, we generally believe that the Fed's going to overweight labor data. And John, you're right. The labor market right now is really strong. Breadth is kind of narrow. We think that the labor market can best be summarized as one where there's not a lot of firing, but there's also an increasingly slower pace of hiring. And the claims data very much points to that. It's still a very healthy labor market overall. Yeah. But continuing claims, really, if you look at a 4-week moving average, they continue to edge up over time while initial claims stay stable. And if that trend continues, I do think that the Fed's going to be seeing a labor market that maybe has less breadth and a little bit more concern than at least what the most recent Fed meeting would lead us to.
I'd be the first one to acknowledge that it won't take much of a downside surprise next week for a lot of people to start pricing in more rate cuts from the Federal Reserve.
Well, that's an interesting kind of dynamic that's changed in terms of where the bias is for this rates market and whether it's set up more for a rally than, say, a sell-off.
Mark, Stephanie, to the two of you, thank you. Good to see you both. Mark Cabana of Bank of America, Stephanie Roth of Wolfe Research.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.